Hey, Kevin here, top 100 financial advisor and best-selling author, and we are here to talk about the stock market. We need to talk about corrections because we are close to correction territory, and the question is, well, how long is this going to last? Like, when is this going to be over so I can get back to the green? I'm tired of seeing red in my portfolio. I haven't seen this in a long time, and if you just started investing, this is not fun. It's not fun at all. However, there's actually some bright news right around the corner. So first, let's talk about what a correction is. A correction is a 10% dip in the market. Basically 10% from its most recent high, which is basically saying, hey, the stock market was here and it was in December. It was all-time highs back then. Feels like a long time ago, even though it wasn't. But the stock market was here, it was great, and now it is 10% less. That is a correction at 10%. Now things get worse once you hit 20% because that is what's called a bear market. Since the year 2000, there have been 10 corrections since 2000, and most of these you do not remember. In fact, I would venture to say that you don't remember not a single one. What you do remember since 2000 is probably the bear markets, which again, those are 20% or more. Since we're talking about bear markets, that has only happened in 2000, 2007, and then 2020. The interesting thing about 2020 is even though we had that bear market was down 30-some-odd%, it fixed itself and recovered within 3 months. There you go. Now that is not typical. It normally takes 18 months to recover from something like that. But we got past it and the stock market was fine, and we were actually up that year within 3 months. By the end of the year, things were good. And that was in 2020. That was from a 30% bear market. It wasn't even started off as a correction and then it got worse. So we are not where we were in 2020, at least as of today. The market is down about 9%. So tomorrow, depending on what happens tomorrow, and I ain't got no idea what's going to happen tomorrow, but you can start to see more of those headlines about a correction. So I'm going to give you 4 tips to help you navigate it. But the other good thing is throughout history, on average, we tend to get over a correction within 1 month. That's it. I know we're super focused and just like, oh my God, the market is down every day. I open my account, it's red, it's red, it's red. What do I need to do? I'm checking my 401k. Like, there's a lot of panic, but again, we tend to, psychologically, when we see these losses, we feel worse than when we actually gain. When the market was at all-time highs, y'all weren't, oh my God, like everything's great. You're like, oh, okay, all-time high. Didn't think nothing of it. In fact, we hit an all-time high, 70 times in 2021, and there weren't that many people celebrating. But you get one correction. And everybody's up in arms and everything's wrong, right? So within a month, on average, we'll see what happens. Now, I'm not saying that, February 25th, that things are going to be fixed, but on average, that is the case. We'll see what happens. Now, these averages are exactly that, averages. If you go back to 2020, or not 2020, this is 2022. So if you go back to 2020, you'll see those videos that I did back then. The bear markets, we normally recover within 18 months, and we did it within 3. So, averages, they tend to move. So we'll see what happens there. But, a 10% dip, realistically, when you zoom out and you look at history and see how we survived all these other dips, or all these other corrections, it's really not that bad if you take the right precautions. So I got 4 tips. I got my notes here, and we'll go through those, and we'll, go throughout our day. All right, so tip number 1, reevaluate your risk. The interesting thing about my job and what I do every day and putting out videos and talking to y'all on Instagram and public and all these other places is, and in doing it for almost 12 years now, I know what y'all be talking about. I know what some of y'all be investing in because y'all say, hey, look, I own this thing. Should I get out of it? I own, someone was asking me about Salesforce the other day. I forget the other stock. When people say, hey, I'm investing in this, what should I do? I bought Coinbase. What should I do? Well, here's the thing. This is the time to reevaluate your risk. I tell y'all all the time that if it's an individual stock, I try not to go above 5% of my overall investment holding. So if I got $100,000, I'm not putting more than $5,000 in one particular company. Because in times like this, let's say, I don't know, Square, now known as Block. I pick on this one all the time, but Square or PayPal or Coinbase or Robinhood, these stocks have not done well. If I put more than 5% in it, let's say I put half my money in one of those companies because I really believe in it, that's half your money gone right now. And in a year like this, even if the overall stock market recovers and the market ends on a regular note, it doesn't mean those companies are going to go along with it. The market is moving and shifting in a different direction. So you need to sit down and say, look, here's the companies that I've done research on. Keyword, you've done research on it, and here's how I'm going to adjust my portfolio. I'm going to make sure that I have my money in different companies and also in different industries. That's another thing when we talk about risk. Technology has always, not just now, but it's always been a little bit risky because you've got your Apples and your Microsofts, and maybe if you want to throw in Amazon in there. Yeah, those are relatively established. But that's not all, right? We've got a bunch of stocks in the metaverse. You've got a bunch of tech stocks like Unity Software, ticker symbol U, that started off amazing and then wasn't anymore, right? So you got to say, okay, maybe I'm having some tech. Maybe I got my consumer staples. We've talked about those. Maybe I've got my REITs. We've talked about those. Let me also get some healthcare. Let me get, I don't know, energy, materials. Make sure you're having those different parts of your portfolio so that if tech doesn't do well, which it hasn't, you have other pieces to buoy you, to help you to kind of offset some of those. If you take a look at my portfolio in public, it's not the most diversified. I'm not showing that as a shining example, but you'll notice though that I've got Apple, Microsoft, Google, Amazon. We got those, right? But I also got financials. I also got a Target in there. I have a REIT in there. It's not all, oh, he just has everything in tech and that's just the end of it. That's not the case, okay? So you want to make sure, reevaluate your risk and say, okay, am I okay putting 15% of my money in one stock? Is that okay? If this continues to drop, can I be okay with that? Can I continue to hold? Or am I going to have to reevaluate my life? Which is what some people are learning the hard way right now. I've seen some people where I'll scroll through and they got 5 stocks. Now, I don't know how much money they have in it. So, that's, we'll see, right? Like all my money isn't in one place, it's spread out. So, these are questions you have to ask yourself. Take the time right now and reevaluate. Is this all the money I want to put in this company? Do I need to say, look, I need to have more in bonds? Maybe. Do I need to have more in dividend stocks, which tend to be a little more stable? This is the time, because when we do these risk tolerance questionnaires as advisors, what a risk tolerance questionnaire is, here's how, if the stock market drops this, what are you going to do? Buy more, sell, or do nothing? You have your answer right now, because we're very close to a correction. And what did you do? So if you sold and you are looking at your account and you are close to panic territory right now, then you need to reevaluate your portfolio and move into something that's a little more conservative. If you're fine and this doesn't bother you, then you're good. If you're somebody who's buying up more opportunities, then you might be okay. But if you are panicking, you're like, oh my God, I don't like this. I need to sell. I need to get out of this stuff. You need to take a hard look at your portfolio and readjust it because it does not fit your goals. I'm good. I ain't panicked because I know what to expect. We've been doing our research. Everything that we've talked about, for the most part, has happened, right? I didn't think it's going to be this bad, but we've been talking about interest rates forever. We've been talking about real estate and stuff forever. So, hey, we expect it to be down. Was it down 10%? No, but hey, not anything to be worried about. But that's only because I made those moves earlier. I made these moves kind of over the summer and definitely in December. It's why I kept Target. It's why I kept Capital One. It was in the financial space. We expect finance to do well. So we keep it. We don't have to move. Okay? So you want to make sure that they fit with what you expect and fit with who you are and how you react to risk. So that's number one. So long number one, but that was number one. Next on here is stick to a plan. I can't tell you what your plan is going to be. I can tell you my plan though. So for me, my plan is come this Friday, I don't care if the market is up. I don't care if the market is down. I am dollar cost averaging. And this could be, let's say that the market recovers next month. It could not. We'll see. That I just happen to buy at the right price. So if this is that discount area and the market is truly on sale and it's going to bounce back, which eventually it will. I don't know if it's going to be next month or not. It could be next month, it could be next year. But if this is that point where we're buying low, then stick to that plan. If your plan is to not touch anything and wait until next year, then do that. If your plan is to, not do anything and check in 6 months, then do that. Okay, so this is that part. And also, when we talk about my philosophy in reevaluating, not necessarily selling, but reevaluating in 6 months, this is one of those reasons. If a correction is going to fix itself within a month, then there's no point in me panicking. Then there's no point in me, getting up in arms and trying to like jump in and out of things if it can resolve itself so quickly. We saw a bear market 2 years ago fix itself within 3 months. So waiting it out could be a strategy for you. If you are already invested in quality investments, index funds, companies that, are real and companies that make sense, then you can sit back and relax. You don't have to DCA. You can just sit back and things could, not a guarantee, they could come back on their own. We've seen it recently. Okay, so it's not something that's far-fetched. It's not something we're making up. It actually happened, and it's happened more than once. So you can sit back. That could be the plan. You can dollar cost average. Just continue putting whatever money you're putting in on a regular basis, 2 weeks, whatever it is, and just let things roll, but stick to a plan. What you don't want to do is wake up every morning and come up with a different game plan. And you say, oh my God, the market's down, I'm going to sell. Then the market is up, oh, I'm going to buy it back even though it's more expensive. That's not going to help you. You need to sit down, create a plan, stick to that plan. Y'all know mine. And I really think most people are good with the schedule, whether it's an annual schedule or a biannual schedule, where you can say, this is what I'm doing. These are the points of the year. Even you can do it quarterly and say, these times of the year, this is when I'm making those moves. Because when you take yourself out of it, you can allow the market to recover. You can allow things to happen and then readjust during those time frames. And during those scheduled times, you can make those adjustments and have more clarity when you do it. You trying to buy and sell in the moment, in the day things are bad, doesn't really help you, because the very next day things can be different. Or even like we saw yesterday, the last 20 minutes can be absolutely different, because you could have sold, right? You could have absolutely sold at noon yesterday for a loss and then wait until the end of the day and then the stock was up, and you look around like, well, what did I do that for? And then you go back and you buy this morning and then the market is back down, and then you're really upset. That's why you don't want to do that. Okay, the last 48 hours or last 24 hours, I guess, can teach you why you don't want to do it in the moment. So have a plan, stick to that plan. Okay, all right. Number 3 is you might want to play defense. We talked about defensive stocks before. I'm not gonna rehash that list again, but you might want to consider playing some defense. Now, I personally like always having a little bit of defensive companies in my portfolio, one for times like this, but also they tend to be solid. They tend to pay decent dividends most times. So I always like to be diversified. I don't have to go and get, if the phrase is stay ready so you ain't got to get ready. So, I always keep a few dividends in my pocket, keep a few REITs in my pocket, so that times like this, I'm like, oh, look at these dividends here. I'm good, right? So you might want to consider defense. I know a lot of people are super, super aggressive, and you're going after what you think is the biggest, next best thing. Upstart, I think the ticker symbol is UPST. They were on fire at one point last year. They just went public. I mean, stock was up 200%, 300%, 400%, whatever it was, and people jumped after it, and then it absolutely crashed, and that be happening, right? So you got to be careful. Yes, you can have those from time to time. 2022 might not be the time, but in general, have you a little bit of defense. Shoot for the moon from time to time, but really the objective is to be somewhere in the middle. Get your little defense, shoot for the moon a little bit, but that core, that middle, needs to be companies that you can rely on. Okay, all right, and then last one, number 4, focus on long term. Again, corrections on average correct themselves. They fix themselves within a month. Don't hyper focus on the first 25 days of the new year. Okay, we got 251 trading days this year. Don't be overly concerned about the first, 15, 16 days. Okay, don't be so hyper focused on the first 15 to 16 days that you forget the other 236 or however many are left. Also, remember, as I brought up those bear markets, those 10 corrections since 2000, long term. If you invested back in 2000, you'd be fine right now. If you invested in 2020, you'd be fine right now. Remember that in times like this. So whether it is, Amazon, which I know hit a 52-week low yesterday, I think that's when I got that alert. Whether it's Disney or something that you really like, what I'm trying to do as an investor is I've said this before, what I'm doing in 2022 is not really for 2022. What I'm doing for 2022 is definitely not for the end of January, and it's not for February of 2022. My job as an investor and what I'm trying to do is to set myself up for the next year, the next 2 years, the next 3 years. So when I made my adjustments in December of 2021, it's really to set myself up for 2022, 2023. So whatever you're doing right now, it's really, how is this going to benefit me in 2023? You're really stacking your chips now with the information that you have to set yourself up for the very near future. Or I would say the future. I won't say very near because it's going to make you think like next week. So when I make my adjustments in June, and I don't know what those adjustments will be because this year has not played out yet. It's too early to make any adjustments for June. But come June, the question is going to be, how can I set myself up for 2023? How can I set myself up for the end of this year? So you should be thinking much longer. And this is why when I sit down, I say you should buy something and see what you can expect within a year or half a year, is to take out the stress and the hyper focus on what happened the first 25 days of 2022. You don't remember what happened the first 25 days of 2021. You don't. I don't. You don't remember what happened in 2020, the first 25 days. You remember what happened in March. Most of us remember that. That was different. But at this point, at the correction phase of this, it doesn't really matter, right? And then also, the last part of it is, unless you are 5 years from retirement, what difference does this make? Right? If you have companies that you can trust, that you can believe in, that you know have a future, and that you know are making money, you got 20 years for this money to grow. Are you going to let the first 25 days of the year throw off the next 25 days of your life? Probably not, right? So think about, I'm trying to pick companies as I'm thinking about them. So let's say a Facebook or something like that. I know Facebook has some issues, some legal issues, but something like that, it's okay, this season is bad, but like, are they still going to be here? Are they still going to be a profitable company? Target, is Target still going to be here in 25 years? Probably, yeah. They're online, so it's not just brick and mortar. So 10 years from now, 15 years from now, am I really going to remember, the first 25 days of 2022, I sold and then I just got out? Usually not, right? Those who are investing now are going to be the ones who benefit in 2023. The exact same thing is what I told you in 2020. Those who are investing and consistent and have a plan and are focused on the long term and are just relaxed right now, those are going to be ones who are going to profit at the end of this year, most likely, and definitely profit in the years to come because they knew how to act. They had a plan and they were diversified right now, and that they were consistently buying in times like this. So this is that call. This is that opportunity to say, look, that's correction territory. Here are the 4 things I need to do. I need to reassess my risk. See if this is really, am I really about this life when it comes to holding this many stocks? Am I really about this life, but in holding some of these innovative stocks? Like take an ETF like ARK, right? ARKK is ticker symbol, that's down like 40%. And it was in all the quote unquote innovative names. That ain't the life for everybody, right? It is not for everybody. So that might be a little too risky for you. Maybe you need to pull it back and be a little more conservative in some areas. So reevaluate your risk, stick to a plan, have some defensive companies if they fit for you, and obviously stay focused on long term. All right, that was long, but you know, I had to rant, had to talk about it, and now you know what a correction is. You have 4 ways to manage it. All right, make sure you hit the like and subscribe button. We are almost to 3,000 subscribers, so that'll be a milestone. Maybe we'll do something cool. All right, talk to you guys later. Bye.